Stock markets too optimistic about China and earnings and the Fed? That's the question on the minds of traders as we kick off this week with record highs for the big indexes. And the question becomes, well, what could go even more right? And if that list is too short, are the markets vulnerable to a buy the rumor, sell the fact kind of a response when all's said and done? That's what we're going to explore now. Macro Money begins right now. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And what we're going to explore here, as we've just alluded, is an action-packed week on the calendar, but one where the markets may have already done the heavy lifting. And the question from a speculative perspective being, are we now about as chipper as we could possibly get on all of what is coming in the immediate future? And what we'll do is we'll take a look at how the markets have done with this sort of lead up from last week coming into this week. Take a look at the price action and consider what that looked like, and then take a look at what is setting up to shape next steps here and whether the markets still have some juice to squeeze out of those next steps. So here is what we did last week. We can see here another supportive week for stocks, albeit relatively modestly so. S&P up 1.9%, NASDAQ up 2.1%. So we continue to, as it were, crawl higher. Not huge gains, not huge increases in momentum here, but nevertheless, upside progression continues. And if we look across the rest of the asset universe, we largely find a sort of familiar narrative. Now, we should mention that much of what we got here from stock markets last week came thanks to Friday's U.S. CPI report. That was the real big catalyst that took us through October highs and not only erased that big sell-off that we had across markets on October the 10th, but took us north of those levels. And of course, we have continuation on that today. Markets continue to push higher with a gap at the weekly open, thanks to news over the weekend that U.S. Treasury Secretary Scott Bessent and other negotiators from the Trump administration have reached a whole range of preliminary goodness with their Chinese counterparts, and that the thing that's going to happen next, the big meeting with U.S. President Trump and China's President Xi Jinping this week, is almost like a rubber stamp exercise, where they are going to meet to approve all of these great things. And to paraphrase Mr. Bessent here, that 100% tariff on China due to kick off on November 1st, that's basically, according to him anyway, off the table. And so a whole range of interesting things perhaps on the menu here. The standout last week, interestingly, was, of course, crude oil, 7.6% jump there. That's after the U.S. Took sanction measures against Lukoil and Rosneft, the big Russian oil producers, and took the approach similar to what has been done before, for example, to Huawei, where rather than attack a country, these measures essentially speak to third participants in markets, so anybody that might do business with these companies, to say either you do business with them or you do business with the U.S., you choose. And of course, that means access to US credit markets, that means access to the dollar, so on and so forth. And so, much as Huawei was squeezed out of the 5G global infrastructure by the US saying, if you do business with them, you're not going to do business with us, it seems like we've taken a similar approach here with these major Russian oil producers as a way to try to say, well, here is a way to implement sanctions whereby they would be more difficult to circumvent. And rather than essentially say, oh, well, Russia doesn't have the shadow fleet or various other workarounds to stop this, we're instead going to go to the customers and say, if you do business with these places, it's you that's going to get cut out. So do the risk management thing and don't do business with them. On this basis, of course, crude oil jumped higher. And we'll see if this continues to work out this week. One of the key things to consider here, of course, is whether this might be something that is part of the Besant and Trump and China conversation that we've been at least somewhat promised, and that seems to have the stock market all kinds of happy at the start of this week. China, of course, the buyer of consequence of Russian energy at this point. India too, but certainly China front and center. And so if there are these new restrictions on buying Russian crude, perhaps there's a deal to get done here. Perhaps this is part of the US-China negotiation. And if so, then crude might have something of a wild week this week after that major rally, either building on it or coming the other way. It would seem, one would imagine, that if it is all roses here going into this meeting for Trump and Xi, then there is some sort of a release valve that is going to get turned here, and crude may very well deflate as a consequence. Gold came back a little bit last week, down 1.8%, but of course, it's still only a tenuous decline. It is a little bit lower again today around this US-China hopium, but we'll see if that continues. It does look like some speculative appetite has been coming out of gold here, and it seems to be receding, but so far, relative to its aggressive gains, the pullback has been generally modest. The dollar continuing to look strong last week, up against both the euro and the yen, with the yen having the outsized weakness there as the new prime minister, dovish as she is, manages to cobble together a coalition and actually take office. Bitcoin doing its risk appetite on steroids thing, where when stocks are up, it is up more. And so it bounces 3.8%. But of course, that's after an 8.8% sell-off. So on net, the down move in Bitcoin seems to be generally continuing over the past several weeks. Now, it was the US CPI report that really got markets in a happy mood on Friday. We can see what happened here. Inflation came in a bit lighter than expected, 3% on headline and core versus 3.1 expected. And if we look at the breakdown here, we can see still the majority of inflation, of course, still in services, 2.12% or percentage points of the three at the headline is still services. Goods, though, we still see somewhat elevated and inching higher, but not worse than it was in August. So August gave us the highest goods inflation for the better part of 3 years. But it doesn't look like things got worse in September. And so you have this sense here that perhaps you don't really have a major sort of spook here, or at least a spook that's become spookier around absorbing higher costs from tariffs. On the energy side of things, a little bit perkier in terms of what's going on, but still by far the smallest contribution to overall inflation. If we look at some of the changes here, we can see a significant increase really just in the energy side of things, whereas goods inflation, as we just said, didn't really go anywhere. Services a little bit softer, just 6/10 of a percentage or 6/100 really of a percentage point off. So very, very minor. And food basically steady as well. So not anything in this story here that would suggest that the Fed would be this or that way inspired against rate cuts, which is really the test here. This was really what we were looking for. Now, there is still some disconnect here, and this is where perhaps this story has a bit of a overheated character to it. Obviously, nobody's going to be surprised when the Fed cuts by 25 basis points this week. That much has been thoroughly priced in. This is from the CME Fed Watch tool, and we can see here that we're hugging just a touch below 100% likelihood that this 25 basis point cut is happening on Wednesday. That's, of course, the biggest piece of event risk this week, the Fed policy announcement. We can see that's basically unchanged versus Friday or a week ago. And so this is fairly steady. Nobody is really looking for any kind of shock here. We'll see, of course, what the policy statement says and what Fed Chair Powell says after in the press conference, but no real shockers here. We likewise see that for December, another one of these 25 basis point cuts is firmly baked in. Now, it's not quite as dramatic as it was a week ago, where we were within a hair of 100%. Now we're sort of in the lower 90s, but nevertheless, this is overwhelmingly convincing and pretty much in line with what the Fed has given us in September's summary of economic projections. If we see here, we've got 3 rate cuts implied here, from 4.4 as the median rate down to 3.6. And we can see, of course, September has already given us 1 cut, and the other 2, October and December, are fully baked in for the remaining 2 meetings of the year. So there's really no controversy at this point. There is controversy, however, about what happens thereafter. 3.4 on the Fed's view here implies only 1 cut next year. And that's against the backdrop of revisions to inflation on the upside, the unemployment rate lower, growth higher. And this is where the disconnect is, because the markets are much more dovish in their thinking. They've got 64 basis points on the menu for next year. So that's at least 50 basis points in cuts and 14 basis points in the direction of a third cut. That puts it narrowly better than even odds of occurring, 56% chance that we're going to get a third cut. So we are between 25 and 50 basis points apart on what the markets expect versus what the Fed is committed to seeing, and we're narrowly to the dovish side of that. So we're closer to saying the Fed is 50 basis points off as far as the markets are concerned. But in any case, the markets are more dovish than Fed officials are allowing. Still, even though we can see that this is slightly corrected here. And a piece of data that wasn't as closely discussed, but certainly seems consequential here, it came out after the CPI report on Friday. This S&P Global PMI's data set giving us accelerating growth and showing us that manufacturing accelerated, services accelerated, the composite accelerated. And so we're looking once again at the heady levels of growth that we were looking at in the second half of 2024, which if we look at sort of what the reference points are there, we're looking at second half of 2021, early 2022. So 2 and 3 year highs for economic growth. So if that's in fact what's going on, that ostensibly has an upside knock for inflation. And then how do you end up with all those rate cuts? Maybe the Fed is right to be more circumspect. So if we get this rate cut, which is widely expected, the question might well become, well, okay, we knew that, but what has this narrative done for us lately? The other spot where we have, as expected, types of conversations, of course, the Wednesday Xi and Trump meeting, where again, we've painted the tape so positively going into it that perhaps the question is, well, okay, if the president can get as upset as he can to cut off negotiations on trade with Canada because of a single ad that the provincial government in Ontario put out there, what might he come up with as a reason to disappoint investors on this China conversation if all of the positivity is already in the market? And then there is the remainder of the economic calendar for the week. Other than the Fed, we are going to get a monetary policy announcement out of the European Central Bank. They're not expected to do anything. In fact, they're baked in for standstill for the rest of this year and all of next year. And then in Canada, we're expecting a policy announcement same day as the Fed. They're seen cutting from 2.5 to 2.25. That looks pretty well baked in. No major surprises there. And of course, with the gravitational pull of the Fed announcement, it's unlikely that we're going to get a whole lot of attention paid to what the BOC does. The GDP numbers due for the third quarter out of the Eurozone on Thursday. They're expected to give a slightly weaker growth, but since they're coming out leading into an ECB policy announcement, probably not a big mover. And we might get the BEA releasing the PCE inflation numbers on Friday, but of course that's a function of the government shutdown, and we'll see if that occurs. CPI, of course, came out, but PPI has not. So we don't have all of the components that we need to reconstruct it, and we'll see what happens there. If maybe the shutdown ends or there's a special dispensation that's made. The other thing, of course, where optimism has blossomed, and the question necessarily is, well, how much more optimism is there to be had, is the earnings front. And here, not much is on the menu, relatively speaking. Obviously, there is a whole sea of names on this calendar this week, and so I've boiled it down just to tech, and already even in that space, there is a sea of names. But of course, the really big news here is going to start, as most things apparently this week, on Wednesday, where the trillion and higher market cap names are clustered. Microsoft, Google, Meta, all reporting. This will be a interesting after hours cherry on top of the event risk Sunday here. Obviously, we are going to have the Fed already out by the time these numbers are out. We are going to have the Bank of Canada rate decision out. Ostensibly, we might even already have the Trump-Xi meeting results somewhat at least understood, because they'll be meeting in South Korea. So by the time we get the market close on Wednesday, it will have already been the business day of Wednesday the 29th in South Korea. So perhaps we will already know what the Trump-Xi situation looks like and where it stands before even the Fed's out. And by the time these numbers are out, the Fed will be out as well. So we'll see what that looks like. It'll be interesting to see if, even on the basis of all of that, the markets are able to find some sort of directional conviction, because Thursday we get one more little tidbit by way of earnings from Apple, another of the Mag 7, and of course also a trillions market cap type of name. So lots and lots of heft here for the overall market. And again, the question, as it is across all of these narratives, well, we're as happy as we can be about the US and China. Good. We're fully baked in for what the Fed might do and more. So we're as happy as we can be about the Fed, and happier even than the Fed is actually admitted to themselves in their forecasting. We're exuberant on earnings, at least as far as the market has not sold off when those earnings have missed a bit. They haven't very much, but if anything, Tesla was a bit soggy. But for the big names, Netflix was a bit of a letdown and didn't really impact sentiment. Tesla was a bit less than great, a bit underwhelming. That didn't impact overall sentiment. So what would need to happen here from these results? How much of a blowout would there need to be for the markets to get even more happy? And are we now asymmetrically more vulnerable to a slight miss than we are to even a great upside outcome on any of these narratives? And so with that in mind, I have somewhat adjusted my exposure. Of course, when stocks broke out after the CPI report on Friday, I took my shorts in NASDAQ and the S&P off the board. Small losses as we continue to find where this speculative top might be. It's obviously not here because we've now made a higher high. So I'm out of those, and I do those in small size and in risk-defined verticals for a reason, because fighting a market is expensive if you don't do it in very, very, very risk-defined small exposure type of ways, which is the way that I've approached it opportunistically when opportunities present themselves and when the breakout occurs. If it occurs the wrong way, well, then idea tested and no, not the time. So back up, take your loss, and look for the small losses to be very much overwhelmed by a large, big sell-off when invariably it does occur. So I still have long dollar exposure. I haven't touched any of that. Still short against the Aussie, the pound, the euro, and the Canadian dollar. I am, strangely for me, for how skeptical I am of the of where the big indices are going at this point, slightly net long in stocks world, because I still have this long-term exposure to Brazilian stocks. I'm still holding that. Still short a little bit of gold. That continues to work. I sold calls last week when things started to break down, and I still have that. Still a little bit short Bitcoin, which is obviously not working, but it hasn't crossed the kind of Rubicons that stocks have, and so I still have a little bit of risk-off exposure here. Still long the bonds. Those continue to climb higher. In fact, the long end continues to outperform the front end. So the calls I have in TLT continue to quietly work in the background. And I've gotten a little bit short crude oil here, looking for maybe some sort of a dispensation for China out of this conversation with Trump and Xi this week. Maybe that gets a little bit of relief. Maybe China gets some kind of a door to keep buying cheap Russian crude as a part of this negotiation. And so maybe some of this concern last week about Lukoil and Rosneft gets undone. So just tactically a little bit short with a put vertical over 53 days here, taking a little bit longer to dilute exposure to Delta so as not to get my face ripped off were this to suddenly rally up a storm. And so far, looking at that as the portfolio for the week ahead. And that's Macro Money. As ever, we are here Monday through Thursday, right after Overtime, a show I typically co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. Also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.